buyers can easily buy 20, 30, 40, 50,000 of the big S&P futures in a single day. And so they can go right through these levels and stop you out as much as they want. But once they have their position, they usually don't deviate from where they're going. And so the biggest choppy point to trade in is that first half hour or so. Most days they can also pivot in this 1 to 2 p.m. period. And this is because mutual funds often give you a couple times to get in and out during the day. One is on the opening. Another one is usually from 1 o'clock. There's a cutoff. And so whatever they receive by 1 o'clock, they either have to liquidate or put into the market. And so by 2 o'clock, it shows up, and most everybody knows. And sometimes they also have another cutoff at either 3 or 3:30. The 3:30 one is very important because there are a lot of ETFs around that are leverage ETFs that are 2 times the S&P or 4 times the S&P. And depending on what the S&P has done during that day, they are legally obligated to buy that many S&P futures in a multiple amount to be hedged against what their prospectus says they're supposed to do. So if they were fairly bullish and the market's been down all day, now they have to sell short 2 or 3 times as much as they normally would from 3:30 to 4. And this is what causes a lot of these big breaks in the last half hour or so. So be aware of those turns. Many good traders used to have a rule that they would never trade against the trend in the market at like 7 minutes after 3 p.m. or 10 minutes after 3 p.m. As you get into that last hour of trading, most of the big money knows what it has to do in the last hour, and the S&Ps will start to trend. Although more and more it's approaching 3:30 when they really see that cutoff now. Also assume that the futures always know what's going on. They really are a lot of crooks in the market. They all have inside information. The institutions are so big these days that they put out these big $3 and $5 billion programs for bids at 3 or 4 different firms. And they ask the firms to bid on them and give them a net contract price for buying or selling the entire portfolio. So several firms know it's coming to market. They just don't know which firm won the deal and is going to bring it to market. But as soon as they find out it's a sell program, they're going to establish shorts and get in front of it. And that's why you often see the market take a dive and you don't really see any real selling of stocks. It's really quiet. There's no volume. But these guys know the program is going to hit in the next day and a half. And if it's a sizable one, they know it may take 3 full days to execute. And so they will always try and be on it until the last day. On the last day, only the guy who's executing the program knows if he's down to tag ends. And then there's always a little cat and mouse game where he does a little selling and walks away. The rest of the street thinks he might be done, and they rush in to buy, knowing that the program was out there and there's no reason for the market to be down. And if he's done, they want to go long, only to see him come back 10 minutes later with yet more for sale. And that's why you get these choppy probing bottoms after 2 or 3 days down. So they always know what's going on. And because they always know what's going on, if you have a strong up day and the S&P futures don't liquidate in the last hour and certainly in the last half hour of trading, or if you watch from 4 o'clock to 4:15 on the runoff, if there's no significant volume liquidation, it means they are going to buy them again on the opening. It's not a question of luck or a lucky guess. They have a program in their pocket, and they know how much they have, and they've saved some. And what they're going to do is open them up and get a higher price, and then they're going to liquidate their futures. And that's why I usually have a rule that you can't reverse the market one day by reversing the direction. So if a market closes strong and it opens down the next day, it doesn't usually reverse the strong close. They open down, they turn around, and they'll go up on the day later in the day. But when you can reverse a market is when you're going in the same direction. If you close strong and open strong, then they can sell out, reverse, go down on the day, and keep right on going. Same thing is true in a down day. If you have a big down day and you open up, that's just short covering. That doesn't reverse the downtrend. And after the short covering's done, they collapse and they go to a new low. But if you have a big down day and they open down even more, that may be the program finishing and they get everybody trapped short, and then they reverse and they go up and they keep going. So they can't reverse the trend by doing the opposite overnight. All they can reverse the trend is if they do the same thing. So if the S&Ps do not liquidate and they open higher, you have a potential reversal where they can go down that day. Because the inside information is so abundant these days and everybody knows what's going on, or at least all the big hedge funds know, options play a very important part of what's going on in the market. And often these days, there's a lot of market on close programs and markets that have programs that are going to execute all day long that the insiders know about. And certain stocks are key stocks in the indexes that they're going to manipulate all day long. So it's really important to punch up a screen that has listings of options on it on the stocks that you are trading in the first hour of trading. It will usually take until about 10 a.m. or so in the morning to get enough volume to see anything significant. So I usually every 15 minutes in the morning before I'm buying or selling stocks, I will punch up option screens on those individual stocks. And I'm particularly keen on looking at stocks that have 2,000 to 10,000 call options, and they're all up on the day. And then you have the same amount almost of put options that are down on the day. And then I want to see the stock up. So that means the puts and calls are front running the stock. There may be somebody who has to buy 3 million shares of stock that day, and he's only bought 100,000 on the opening. But by buying 2 to 10,000 calls and shorting 2 to 10,000 puts, the insiders who know and have the leverage know that he'll be out there all day long, and at the end of the day, the puts that they sold for $1 would be 50 cents, and the calls that they bought for $1 will be $1.50 or $2. So watch for the heavy volume in the call options in that first hour in particular. When you see it, always buy the most expensive options in terms of premium, because they reflect the inside criminal knowledge of the buyer selling working the floor. Don't look at a Black-Scholes model or average volatility in terms of what's expensive or not. And I don't mean buying a Google option for $40 or $50 meaning expensive. I mean if you look at an option and it should be selling for about $1 on most days, and suddenly it's selling for $1.50. That extra premium means that somebody is so certain he's guaranteed that that stock is going to explode that he's willing to pay a lot of extra money to get a lot of volume. Usually when you see that within 2 or 3 hours, that particular stock might be up $2 or $3. And it might go up $5 or $10 that very week if there's a big recommendation coming. So always look for options that have a lot of volume and pumped up premium. Also, I never buy more than 3 or 4 weeks at a time. If you're not good enough on your timing of the market and your trend lines and your knowledge of what's a trend and what isn't, you shouldn't be playing options at all. If you have to buy 4, 5, 6 months of premium, you're going to pay far too big a penalty. So you only want to buy short-term options. Ideally, I'd only buy options that were good for a week or a week and a half if I could all the time. But most of the time, you're going to find options that are, 2 weeks to 4 weeks left to run on the premium. And I'll try and buy them fairly close, maybe 1 strike above or 1 strike below on the puts. And those would be the type of options that I would buy. Now, what these really look like is here's a typical page of an option. And it's the letter X, which is U.S. Steel. And we see the last trade is 54.80. It's up $1.80 on the day already. And since it's at 54.80, we go down the strikes to see the 55 strike is the current strike. And we can see on the left side, these are call options. And these are all for the month. Then we can look over here at the put option page. And we can see that these are the puts on this side. So the first thing we want to see is the volume. What pops out at me is this huge amount of volume, 3,000 options, 4,000 options, 3,000 options. So the options are trading in size. They're up 50 cents on the day. The premium is all up on the day. And we look over on the puts. And here we have 1,100 puts trading down $1.25. Here's another 1,200 puts down 49 cents. Now here's a misnomer. It shows 1,100 traded. And it shows they're net change $1. That just means they haven't traded before and there's no outstanding interest. That means this is the first trade they put on this day and somebody paid $1 for them. So that may be theoretical premium anyway. It's not a net change of $1. But we can see here that the puts are all down on the day on heavy volumes and the calls are all up on the day on fairly heavy volumes. Now the premium levels are not unusually big. You're at the 55 strike and the calls going up are $1.78. And the puts going down are $1.97. The puts are actually a little more pricey than the calls, but after all, on the put side, you're 20 cents in the money already. So that's the difference. So they're about fairly valued, but the fact that you have the big money buying all the calls and the up strikes too. They're buying the 60s here, and they're buying 65s, which are really a crapshoot. They're buying options here that are 8 cents. Because they know something. Maybe tomorrow it will be 25 or 50 cents. Maybe it will go to the 62.50 strike in a day or two. Don't know. But the fact that they're buying all these in volume and the fact that they're selling all the puts across the board usually is quite bullish. On this same day, this is what happened to the stock. This is like a 15-minute chart or so. And this is where the stock opened that day. It just gapped open. And for the first hour or so, it went straight up a couple of dollars. There was a little shakedown, and you notice it was a very sharp shakedown of only 3 or 4 bars. But it was enough to get out all these day traders who had been buying it and using a stop in here. It shook them out almost back to the opening, and they were frightened. But all the people who bought those puts and calls knew what was going on, and they immediately bought the stock, and it closed at the extreme high, up about $3 or $4 on the day. So that's what it looks like on a good day. A bad day would look something like this. Here's a day where the same stock, U.S. Steel, was down $1.23, and it's at 53.5 basically. So between the 50 and 55 would be the most popular puts and calls. And we see heavy volumes, and we see all the calls are down. And here's 10,000 of the 65s. Now they're almost 10 out of the money. So this guy just wants to sell every single one he can short because he thinks they're totally worthless, and he's selling the 60s. He thinks they're worthless, and he's selling a good amount of the 55s too. And on the put side, he's buying in the money puts. The 60s are already, remember, $5, $6, $7 in the money. So he's paying a lot of money in premium to buy in the money puts and at the strike puts. Here's 8,000 out of the money by $3.50. The 50s are out of the money. He's buying a lot of those. And indeed, 2 or 3 days later after this was taken, the stock was down to 47. So these guys knew what they're doing. These are not speculators like you or I looking at a chart. These are guys who are probably illegal front running, and not always illegal. Sometimes it's the portfolio itself who has to sell, 20 million shares of stock in a week for some reason. But a lot of times it's somebody who knows the guy has to sell 10 or 20 million shares, and he's front running him and trading on inside information. But the option guys always know what's going on, and that's the important point. On another subject, one of the most basic principles in stock market prediction is this principle of the square root. This is where reversals occur. And they're based on a simple thing, that all reversals in trend have one thing in common, and that is an equality of time and price. So in the simplest form, I say the number of bars, days, minutes, etc., this is the time period, has to be equal to the price. So if you were 50 days and up $50, that would be a square root. So if you were at a $50 price, let's say, and you moved over 50 days from that top, there would be a correspondence of 1 to 1. You could also have proportions like 4 by 1 or 2 by 1 or even a Fibonacci that will also work. But the 1 by 1 is the most important square root, and that's also why we use a 1 by 1 angle, especially if we did it in terms of days. So if we had a stock that started at 40 and it went up to $50 and it was 10 days later, that would mean it was going up an angle of 1 point per day, and it was resting exactly on that angle. And what typically happens is the momentum is much greater than the 1 point angle. Let's say we're 30 days down the road, but the stock is up $40.